Hi, thank you for joining me. I've heard from a lot of you that you've received your PPP funds or have an acknowledgement that your application has been received and you're approved. Over this time period, we've also received some additional guidance. Ultimately, it relates to sole proprietorships. We have not received any guidance from the SBA or the Treasury about any other entity type. So wanted to take some time, talk through that sole prop, talk a little bit about how that might apply to other entities, ultimately make sure we're getting ourselves set up for the maximum amount of forgiveness that we can get out of this loan. So today we're going to go through some of the SBA's interim final guidance around sole props and the self-employed, discuss the IRS ruling 2032, and I'll tell you what that means, and then ultimately apply it to how does this affect your loan forgiveness, what costs should we be tracking, and how can we maximize that forgiveness. So as we've talked about before, but I think it's important to reiterate, the loan amount calculation does not necessarily relate to its allowable uses, nor does that necessarily coincide directly with those forgivable expenses. So we're going to talk about some of those key differences so that you know how you can make sure that on the forgiveness side of things, you've got your eye on the right expenses. So first, let's discuss that $100,000 limitation. So when we went through the loan amount, it asks us to do a monthly equivalent for $100,000 in compensation. So per month, that works out to be $8,333. Now, when it comes to the actual forgiveness, they're going to break that down on a weekly basis. So that 100,000 divided by 52 gives us $1,923. Multiply that by 4, we have $7,692. So you can see between the monthly, $8,333, versus prorated weekly, 4 weeks, $7,692. What does that mean? Well, for the 8-week period, the maximum allowable forgiveness for any individual, based off of that $100,000 cap, is going to be $15,385. That comes around, and we get that reaffirmed by what amount shall be eligible for forgiveness. This is directly from that interim final ruling. For sole proprietors, that amount capped at $15,385, as well as other covered benefits, but not owners. So if you file as a sole proprietor and you have the Schedule C, healthcare costs that go to your employees, retirement benefits that go to your employees, taxes that go to your employees, all those other benefits, we can use those funds for our employees. However, as a sole proprietor, you cannot use those benefits on top of that 100,000. Now, the other area that I want to point out a difference between the allowable use and the forgivable use comes down to leases. So in the CARES Act, they identify an allowable use as going to be rent, including rent under a lease agreement. Seems to suggest that if we are paying ourselves rent but we don't have a formal lease agreement, that is an allowable expense. However, I know we want to maximize our forgiveness. Pay in close attention that in the CARES Act, they redefine the term rent to mean an obligation under a lease in force before February 15th of 2020. In that same interim final ruling, where we saw the weekly breakdown of 100,000, it further reiterates that rent payments on lease agreements in force before February 15th of 2020, to the extent they are deductible on Form 1040 Schedule C. To me, this seems to require that we're going to have a lease that was in effect before February 15th if we're going to get forgiveness for those rental payments that we make. Now, through rules of attribution, if you don't have a written lease, it is still highly likely that you'll be able to get forgiveness for the interest on the mortgage if you own your property. So just something to make sure that you keep in mind and we're planning around. Now, we also have the forgiveness limitation. So that forgiveness limitation on this side, we're talking about the 75% rule. Something we've all very much discussed, but that at least 75% of the PPP loan proceeds shall be used for payroll costs was language that was kind of put into one interim ruling. Now, what we've seen in subsequent rulings that have come out is going back to the original language, which is 75% of the amount forgiven must be attributable to payroll. I want to see further clarification on this, but from everything that we're seeing so far, it's not the loan amount that needs to be 75%, it's the forgiveness amount that needs to be 75% to payroll cost. The other area where we want to be mindful on our reductions is based off of the number of employees we have. So they're looking at an average full-time equivalent. Based off of everything we've seen, a full-time equivalent is synonymous with 30 hours per week. So average full-time equivalent from February 15th, 2019 through 6/30/2019, June 30th, 2019, so the same period as last year, or between the start of the year and February 29th of 2020. And ultimately that's really dealer's choice. So you as the borrower have the opportunity to choose which of those two employee counts is going to work best for your needs. The other area where we might see a reduction in that forgiveness is if a single individual, so the same individual before February 15th, same individual after, is paid less than 75% of the salary that they had previously. Keep in mind, in both of these instances, there is an exemption if that is remedied by June 30th of 2020. We don't have guidance yet at this point in terms of how they're going to apply that remedy, but it is explicit in the CARES Act, and for that reason, I still hold to the aspect that if we are currently leveraging expanded unemployment for our staff, and we plan to bring back all of our staff by June 30th, we don't necessarily need to be in a sprint to get people onto payroll. We need to make sure we've got a plan for how we are going to have people return to payroll. And then finally, this IRS ruling 2032. Something that I'm sure if you've got a life, you probably haven't heard about yet. Thankfully, I don't. So this is what we looked into. The PPP loan forgiveness won't count as taxable income. That was very explicit in the CARES Act. What this IRS ruling came out to say was PPP loan expenses, those that are forgiven, cannot be deducted as normal operating expenses. We've talked about setting up that separate bank account. We've talked about tying these costs to very explicit transactions or invoices. This makes it all the more important that you have that very lock-solid documentation around which expenses are you seeking forgiveness for. Now, it does feel like a bit of a bummer that we're not going to have that business deduction here, but keep in mind point one. This is not income that we're going to be taxed on. The forgiveness amount is not going to be taxed to us. So ultimately the IRS did this to avoid a double tax benefit of these dollars. This also means to me that because we don't get that double benefit, keeping your employees on unemployment until such time as you need them for operations, or that we might be getting a little nervous about that 75% rule, those should be the guiding considerations. It should not be a tax plate to bring them on for deductions because we won't have those deductions. So kind of to wrap it up, how do we want to manage around these based off of what we know today? And keep in mind, we still have a lot of unanswered questions. There is likely going to be additional guidance as we're making our way through our 8-week period. And so I don't want to have anybody coming out of the gate doing too drastic of actions to meet that 75% threshold, because as we're operating our practice as normal and additional guidance is coming out, we'll be able to provide you with some tools and some solutions to make sure that we get to that 75% number. But first, I still highly suggest that we use a separate bank account. Put the PPP dollars into the separate bank account. If we need to move those over to operating accounts, make sure that we have transactions that align with what that use is. Again, so that we're able to track those dollars for forgiveness, that we're able to identify each one of those transactions, and your accountant is also going to be very grateful that you have all of that identified given that IRS ruling. The second, utilize expanded unemployment and PPP together. That's that aspect that I talked about, where we don't need to be in a rush to get everybody back in the door, but we should be putting our feelers out and making sure that we'll be able to get people back when it comes time to fully reopen the practice. Track those explicit expenses and forgiveness. Goes into that top piece that I mentioned. Don't feel obligated to utilize the full amount. As I mentioned earlier in one of the slides, There has been one reference that 75% of the loan amount needs to go to payroll cost. All other and numerous identifying language points to 75% of the forgivable amount needs to go to that payroll cost. So as we're looking at, do we hold on to some of these dollars as a low interest rate loan with a pretty bad term at 2 years, or are we just prepaying, paying back what we don't use in forgiveness? Don't feel obligated to try to get to that max loan amount number. As we saw in the very first slide, the loan amount calculation did not necessarily correspond with your business, your practice, or even those forgivable expenses. So we want to leverage the dollars to provide the max amount of forgiveness available, not necessarily the max amount of expenditures we can by using all of the loan itself. And finally, tally your ongoing overhead expenses as we make our way through this. We know those ongoing operating expenses are going to be our rent and those certain utilities that we saw. If you're tracking those expenses, and we've got a good eye on that, the payroll costs that we want to have by the end of that 8-week period is going to be ongoing overhead times 3. That gives us a really solid number to make sure the staff we're paying, what we're doing in retirement benefits, what we're doing in health benefits, that we're not necessarily overspending if we don't have to be. Now, I don't want that to kind of get in the way of any of the business decisions you're going to have to make, but I do want to make sure that what you have is a loan that is designed, or expenses that are designed to be forgiven, a loan that covers that amount, but we don't necessarily need to go up to the entirety of that loan, and that we've got rock solid documentation. So if there's ever a time that they come back to you in terms of justification, you've got that all there and you're ready to go. Keep in mind, the borrower does hold the liability on the forgiveness amount here. It is not something where the lender says this looks good and they're taking any of that off of your shoulders. Let's tread cautiously, let's make sure that we stay in contact, and let's do what we can to make sure we maximize all of the different elements of the CARES Act. I hope you're having a great day. Thank you again for joining me.